the curtain rises, not on a stage, but on the digital ticker tape of the stock market. A new name flashes, vibrant in green. The price soars. A company, born from a garage, a dorm room, an idea sketched on a napkin, is now a titan of industry. This is the IPO, the initial public offering. It's the moment a private dream becomes public reality. It's sold to us as the democratization of finance, the chance for the little guy to get in on the ground floor of the next big thing. But what if I told you this grand spectacle is often a meticulously crafted illusion? What if the ground floor you're stepping onto is actually a trapdoor? Welcome to the world of the predatory float. To understand this game, you first need to see the board. An IPO isn't just a company deciding to sell shares. It's a long, elaborate dance orchestrated by some of the most powerful players on Wall Street, the investment banks. These are the underwriters. When a company wants to go public, it doesn't just list itself. It hires these banks to manage the entire process. The banks do their due diligence. They help set the initial offering price, and most importantly, they use their vast networks to find the first buyers for the shares. Now, who are these first buyers? Are they everyday people like you and me, logging into our brokerage accounts? Almost never. The first slice of the pie, the shares sold at the initial IPO price, goes almost exclusively to the bank's most prized clients. We're talking about massive institutional investors, hedge funds, and ultra-high net worth individuals. These are the insiders. They get the shares at the wholesale price before the stock ever hits the public market. Here's where the performance begins. The investment bank and the company embark on a roadshow. This is a high-stakes marketing tour, pitching the company's story to these institutional investors. They paint a picture of unstoppable growth, of disruptive technology, of a future where this company dominates its sector. The goal is to generate overwhelming demand, to create a frenzy. They want the book of orders to be oversubscribed, meaning they have far more buyers than available shares. This manufactured scarcity is crucial. It's the first psychological lever they pull. When the public hears that the big money is desperate to get in, what does that signal? It screams, "This is a sure thing." The hype machine goes into overdrive. Financial news channels buzz with excitement. Analysts, many from the very banks underwriting the deal, release glowing reports. The stage is set for the grand opening. Then the bell rings. The stock begins trading on the open market. And this is where the trap is sprung. Because of the engineered hype and limited initial supply, the stock price often explodes on the first day. It might open 20, 50, even 100% or more above the initial IPO price that the insiders paid. This is the famous IPO Pop. For the public, it looks like a rocket ship leaving the launch pad. The fear of missing out, or FOMO, is palpable. Retail investors, who were shut out of the initial offering, now rush in, buying shares at these inflated prices, desperate not to be left behind. But while the public is buying, who is selling? Often, it's the very same insiders who got the shares just hours before. They sell their cheap shares into the public's buying frenzy, locking in massive, near-instantaneous profits. This is the first wave of the dump. It's a transfer of wealth from the hopeful public to the connected few, disguised as a market opportunity. But the predatory float goes deeper. Let's talk about the lockup period to prevent all the company insiders, the founders, the executives, the early venture capital investors from dumping their shares on day one and crashing the price. There's a lockup period, typically lasting 90 to 180 days. During this time, they are contractually forbidden from selling their stock. This period creates a second, more dangerous illusion, the illusion of stability. For a few months, the stock might trade relatively well. The initial hype may fade, but the limited supply of shares available to trade the float keeps the price from collapsing. Retail investors who bought after the initial pop might see the price stabilize and feel reassured. They might even buy more, thinking the company is proving its worth, but a clock is ticking. As the lockup expiration date approaches, a shadow looms over the stock. The insiders are preparing to cash out. We're talking about millions, sometimes billions of dollars worth of shares that are about to flood the market. The underwriters, the same investment banks that took the company public, often manage this process. They know exactly when the floodgates will open. And when they do, the principle of supply and demand takes a brutal turn. This massive influx of new shares overwhelms the existing demand. The price plummets. The retail investors who bought into the hype, who held on through the lockup period, are left holding the bag. Their ground floor investment is now deep in the basement. The company's dream has become their nightmare. The founders and early investors walk away with fortunes. The investment banks collect their hefty fees, and the public is left to absorb the losses. This isn't a rare occurrence. It's a pattern. Look at the charts of so many hyped IPOs. You'll see the initial pop, a period of sideways trading, and then a steep decline around the time the lockup period expires. It's the signature of the predatory float. It's a system designed not to build long-term value for all shareholders, but to orchestrate a controlled, immensely profitable exit for the insiders. So how do you, as a retail investor, protect yourself from this sophisticated game? You have to change the way you see IPOs. Stop thinking of them as a golden ticket and start seeing them as a shark tank. First, ignore the hype. The more buzz and media frenzies surrounding an IPO, the more skeptical you should be. Hype is a tool used to generate public demand that insiders can sell into. Your FOMO is their exit strategy. Second, never buy an IPO on the first day of trading. Let the dust settle. That initial pop is not for you. It's the insider's profit. Buying into it is like paying a premium to take the risk off their hands. A truly great company will still be a great company a week, a month, or 6 months later. If the investment thesis is solid, it doesn't need to be acted upon in the first 5 minutes of trading. Third, and this is critical, always know the lockup expiration date. This information is publicly available in the company's S-1 filing with the SEC. Mark that date on your calendar. Watch how the stock behaves in the weeks leading up to it. Be extremely cautious, as this is often the moment of maximum danger for retail holders. Many sophisticated traders will even short the stock in anticipation of this event. Fourth, do your own fundamental analysis. Don't just read the headlines. Dig into the company's financials. Is it actually profitable? Or is it burning through cash with no clear path to profitability? Many recent IPOs have been for companies with exciting stories but terrifying balance sheets. A great narrative doesn't pay the bills. Revenue and earnings do. Understand the business model, the competition, and the valuation. Is the price you're paying sane, or is it based purely on speculative hope? The financial market is not your friend. It's a battlefield of interests. The IPO process, in its current form, is one of its most cleverly disguised predatory mechanisms. It preys on hope, on the dream of getting rich quick, and on a fundamental lack of understanding of its inner workings. But by arming yourself with knowledge, by cultivating skepticism, and by exercising patience, you can refuse to be the prey. You can sidestep the trapdoors and avoid the predatory float. Invest in businesses, not in hype. Wait for the storm to pass, and then, only then, see if there's anything of value left standing. The real opportunities aren't found in the frenzy of the first day, but in the quiet analysis done long after the initial bells have stopped ringing. Thanks for watching. Be smart, be safe, and I'll see you next time.